Audio Jungle.
आप सब ने वॉरेन बफेट, मोनीश पाबराई, मिस्टर राकेश, जेमी डिमॉन एंड मार्क क्यूबन जैसे टॉप नॉच स्टॉक मार्केट इन्वेस्टर्स के बारे में तो सुना ही होगा और आपको ये आइडिया भी होगा हाउ enormously wealthy these notable investors are. And I'm also sure at some point you would have also wondered ऐसी कौन सी strategy यूज करते हैं ये investors जिससे they keep making huge additions to their wealth while you and your fixed deposits could barely beat the inflation. Do you think investing in stock markets is something only the professionals can do? Or is it that you're unaware of the strategies big names like Peter Lynch, Warren Buffett, and even Mr. Radhakishan use? Before we answer your questions, consider subscribing to our channel and pressing the bell icon so we could continue making such videos and you could get your questions answered at the same time. Now getting back to the strategies. There are initially three of them: growth investing, dividend investing, and value investing. However, in तीनों का underlying goal is to somehow make you rich, obviously. However, abhi tak ke liye, we'll only stick to knowing what exactly is growth investing about and how is it different from dividend investing and value investing, how big bulls of the stock market use it to compound some serious cash in the long term, and how one day we all could benefit from growth investing and its wonders. According to the legendary investor Thomas Rove, the growth stock theory of investing requires patience but is generally less stressful than intraday trading and reduces brokerage commissions and taxes. Growth investing is a strategy that revolves around capital appreciation. This is simply like aapne kuch stocks kharide when their prices were low, you held tight onto them for a good time. The company performed well and then you closed your profits after selling them when the share prices had risen. The word growth means that a company has substantial potential for capital appreciation. That also means that if you had invested in Netflix in 2010, your $1,000 investment would have been over 30 times your initial investment just after 10 years. This is the secret of growth stocks. Fast-growing companies often provide hefty returns to their shareholders. Big growth names include companies like Google, Apple, and Amazon. Each of these companies has performed extraordinarily when compared to the market. Google's stock price has quadrupled over the past 5 years, Apple's stock has grown almost threefold over the past 5 years, and the Amazon stock has almost doubled. Ab tak, we have already discussed what growth investing actually is and also a few ideal growth investing related stocks the stock market has witnessed. Now, let's dive deep into a few beginner-level misconceptions built around growth investing. Number 1. People often tend to confuse the term growth investing with other investing philosophies such as dividend investing and value investing. This is exactly why many beginner investors make some salty mistakes that end up being the reason for them going financially broke. Let's do a comparative analysis and see how these strategies differentiate from each other. When we talk about dividend investing, this investing philosophy involves certain companies which are historically known for giving their investors a good chunk of the cake in the form of dividends. When investors are putting their money in these companies, these dividend-paying companies will simply utilize this capital to upgrade their business model or to reinvest in the business so that the company can grow in the long term. As a result of this maneuver, these companies can generate healthy profits, which are divided among the investors. Dividends can be an investor's charm because everyone loves some quick money. When we talk about value investing, this type of investing is always about trying to find that diamond in the rough. They are hunting for those stocks with great business models, which are currently selling well below their actual values. Sooner or later, the low stock prices will start to bounce back. And this is exactly where these value investors will earn their money. Growth investors, on the other hand, are trying to invest in those stocks which are actually growing at a rapid pace and are outgrowing the market by bringing higher than average returns. Whether it is dividend investing, value investing, or growth investing, every strategy has some pros and cons. With growth investing, investors tend to target stocks that are providing an above-average rate of return as compared to the market in general. Now you might be wondering, isn't this the point of investing after all? Well, yes, but with growth investing, you're in a completely different ballgame. You might be wondering that it's quite difficult to look out for those growth stocks in the competition of today's market. But what if we tell you that it's not the case? Here are some growth investing basics that every investor needs to understand before stepping into the market. According to Steve Masuka, the managing director at Wedbush Securities, growth investing is the search for companies that are growing quickly and more than the market in general. As an example, a company that earned $0.50 per share last year but will earn $1 this year is growing rapidly and would therefore tend to sell at a premium to the market. Now, the million-dollar question is, how can we find these stocks ideal for growth investing? To transform this strategy into a sustainable investing philosophy, every investor should learn how to go about finding these stocks and what are the key characteristics to look for in growth stocks before investing in them. Number 1. Keep an eye out for revolutionary companies. The first thing to do when you're looking for these stocks is to look for those new, high-rising industries. These findings should have a unique and sustainable business model, or in simple words, look for the Google of 2022, the Amazon of 2022, and the Apple of 2022. Analyze the earning potential. The second important step to make the most out of growth investing is to evaluate the earning power of these stocks or their ability to make some big profits in the long term. This can be done by analyzing the financial statements of these stocks as well as the returns on investment. Keeping in check with the directors. When buying a stock, you're not only choosing that particular company, instead you're also choosing the managers of that company, since those guys are the initial driving force and the reason why a company reports positive or negative earnings. Now, while there are many silver linings of growth stocks, let me also make it clear that there are some risks that need to be understood before investing in these stocks. To put a long story short, there's never a 100% guarantee that you're going to wake up, have your breakfast, and make a life-changing profit. There are going to be days where your portfolio will be going into negatives, and that is the harsh truth. The biggest regret that comes with these types of stocks is that they're expensive to buy and hold. Growth stocks typically do not pay any amount of dividends whatsoever, which means you're solely dependent on these stocks to blitzkrieg their way to make some big returns for you. But truth be told, that's not always going to be the case. It works out on some days, but doesn't on other days. In that way, it is safe to say that growth investing is not the ideal philosophy for risk-sensitive investors. But it may be the best strategy for investors with greater risk tolerance and the bigger picture in their minds. Now, to sum it up into a few words, this was just a glimpse of how we all can use this investing strategy to our own advantage. Let us know in the comments, how are you planning to make the most out of growth investing? Until then, make sure you press the like and subscribe button because you don't want to miss out on our stock-related content that can help you achieve your ultimate financial freedom. Remember, the best dividends are always paid out in the form of knowledge. Omega Finance signing out.